Welcome to the Ontario Mortgage and Real Estate Insights Podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamoen, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions. This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their home ownership dreams. Visit realapproved.ca to learn more about how their experienced team can assist you with your mortgage needs. Let's dive into today's episode. Today, we're diving into some significant changes announced by the Bank of Canada and the Office of the Superintendent of Financial Institutions. On December 11th, the Bank of Canada announced its fifth consecutive interest rate cut. This time, they've reduced the policy interest rate by 50 basis points, bringing it down to 3.25%. This decision follows a slight increase in the inflation rate and mirrors the last reduction announced in October. The rate cut is positive news for both current and prospective Canadian homebuyers, as it complements the new mortgage rules set to take effect later this month. Let's discuss these new mortgage rules, which aim to provide more relief for homebuyers. Over the years, owning a home has been a significant milestone for many Canadians, but the dream has become increasingly challenging due to rising home prices and high mortgage costs. The new rules, effective December 15, 2024, are designed to help reduce these barriers, particularly for first-time homebuyers. One of the most notable changes is the expansion of eligibility for mortgage insurance to homes valued at up to $1.5 million. Previously, only homes under $1 million were eligible for a lower down payment of less than 20%, provided buyers took out mortgage insurance. With the new rules, buyers can make a minimum down payment of 5% on the first $500,000 and 10% on the portion between $500,000 and $1.5 million. This means, for instance, that the minimum down payment on a $1 million home will now drop to $75,000 from the current requirement of $200,000. This adjustment acknowledges the realities of high-cost areas like Vancouver and Toronto, where home prices often exceed $1 million. In addition to this, the government has extended the option for 30-year amortizations on insured mortgages to all first-time homebuyers and all buyers of new builds, including condominiums. This change, effective December 15, 2024, allows homeowners to stretch their mortgage payments over a longer period, reducing their regular payment amounts significantly. Another key change is the removal of the stress test requirement for mortgage holders looking to switch lenders at renewal. As of November 21, 2024, homeowners can switch their mortgage to another lender without undergoing a stress test, provided they maintain the same amortization schedule and loan amount. This applies to both insured and uninsured mortgages, offering more flexibility and potentially better rates for homeowners. These measures complement existing programs such as the First Home Savings Account and the Home Buyers Plan, which offer financial advantages like tax deductions and rebates to first-time homebuyers. The changes are designed to make home ownership more accessible and affordable, especially for younger buyers and those entering the market for the first time. As we continue our discussion on the new mortgage rule changes, there's been some debate on whether these measures are truly addressing the core issues of Canada's housing market. According to an article by Fergal McAlinden from Canadian Mortgage Professional, while the new rules are aimed at improving mortgage affordability, they may not tackle the underlying problem of housing supply shortages. The rule changes, which include offering 30-year amortizations to first-time homebuyers and increasing the insured mortgage price cap to $1.5 million, are certainly beneficial for borrowers on the margins. However, Laval-based broker Ryan LaHaye from Planapre Group RLH has expressed concerns that these adjustments do not address the inventory crisis that has long affected the market. He likens the measures to band-aids on a wound that has been untreated for far too long. LaHaye points out that there simply is not enough housing available, and the government's policies do not seem to be focusing on this critical issue. Although these changes are positive for mortgage brokers, as they allow more people to qualify for mortgages, the lack of housing supply in many areas across Canada poses a significant challenge. According to TD Economics, there is an estimated shortage of over 300,000 housing units across the country between 2023 and 2025, with the pace of home building expected to slow down after this year. The Canada Mortgage and Housing Corporation has also highlighted the affordability crisis, particularly in expensive markets like Toronto and Vancouver. On the topic of extending amortizations, LaHaye questions whether this change will have a substantial impact. While it provides some relief to first-time buyers and those affected by higher rates, he believes most people are managing their mortgage payments despite the fluctuations. The idea that these are the boldest mortgage reforms in decades may be overstated, as the real issue lies in the lack of available homes. Additionally, the removal of the stress test requirement for uninsured mortgage switches at renewal time is expected to increase lender competition and potentially lower rates. However, LaHaye suggests this may not significantly benefit brokers, as lenders tend to retain clients with competitive offers that brokers might struggle to match. Overall, while these changes are steps in the right direction for mortgage affordability, it's clear that addressing Canada's housing supply shortage remains a crucial challenge. The measures may offer some immediate relief, but a more comprehensive approach to increase housing availability is needed to truly support homebuyers in the long term. As we wrap up today's episode, let's take a closer look at how the markets reacted to the Bank of Canada's latest decision to cut the interest rate by 50 basis points. This decision brought the policy rate down to 3.25%, a move that was largely anticipated by the markets. However, what came as a surprise was the bank's shift towards a more cautious stance on future monetary easing. The Bank of Canada's announcement led to an immediate spike in the Canadian dollar, as well as bond yields. Specifically, the loonie rose by 1/4 of a US cent, reaching 70.75 cents US from its previous trading position, which was at its weakest since the COVID-19 crisis in April 2020. Meanwhile, the 2-year bond yield, which is particularly sensitive to central bank policy, increased from 2.85% to 2.91%. Following the announcement, money markets adjusted their expectations, suggesting that the era of 50 basis point cuts might be over. Instead, they are now pricing in more modest cuts, potentially 25 basis points, if any. The implied probabilities from the overnight swaps market indicate a 67% chance of a 25 basis point cut at the next policy meeting in January, while there's a 33% chance that rates might remain unchanged. Economists and market strategists have been weighing in on the bank's decision. David Rosenberg from Rosenberg Research noted that while some may see this as a hawkish cut, the bank is still leaning towards further easing, albeit at a more measured pace. Royce Mendes of Desjardins Securities highlighted the bank's intention to reach its policy goals via a slightly different route than anticipated, signaling a potential pause in March. Avery Schenfeld from CIBC Economics pointed out that the Bank of Canada is navigating uncertainties on multiple fronts, including potential U.S. tariffs and domestic fiscal measures. While the bank has dropped forward guidance, economists like Schenfeld suggest that rates might need to fall further to support economic growth, especially with unemployment on the rise. As we look ahead, the general consensus among economists is that while the Bank of Canada may slow down its rate cuts, further easing is likely unless significant economic improvements are observed. The potential impact of U.S. tariffs remains a wild card that could necessitate more aggressive monetary policy adjustments. Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate. Before you go, a quick reminder. Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time and stay informed with the latest industry insights.